The market tried to break out in September. We failed. We've come back in, and we're now at a point in time where we've closed below the highs that we had seen back in January.
That was the fake out.
That was the fake out. We've seen fake outs like that before in 2007. We've seen it in 2000. But here's the interesting thing. On the last advance that we've seen in this market, we have literally seen a fewer number of participating stocks. Fewer number of stocks are breaking above their 40-week moving averages or 200-day moving averages. Yep. And the number of stocks that are actually in uptrends in our work. And again, Brian, we look at over 4,000 stocks every single day, week, and month.
Lazy.
And what we have found that there's only about 28% of all those stocks are in any form of an uptrend based upon our work. So from our perspective, we're not getting the participation as we're moving to new highs, which is a problem.
I know Bob Pisani's talked about this a bit. Jim Cramer has talked about this a bit. But here's the difficult question. Does it matter? Because this is a market that has made its living on about 10 stocks out of those 4,000.
Correct. I will tell you the Fab Five, Microsoft, Apple, Amazon, Netflix, and Google, those stocks have driven about 80% of the performance for the NASDAQ 100 year to date.
Okay, we got to repeat that. Listen, I know it's early, everybody. Take another sip of your coffee. 5 stocks have been 80% of the NASDAQ 100's performance?
Year to date.
Wow.
Correct.
Does that narrowness, though, portend bad things?
Historically, markets will continue to grind higher, but that's not healthy to have that few number of stocks driving the overall performance for the market. If you get an earnings miss from any of these companies, you're going to see a healthy setback and correction unfold. So from my perspective, Brian, I don't like to see the market this narrow. And we start looking at the narrowness of the breadth of the market. You start looking at the flatness of the yield curve. You start looking at the challenges you had mentioned in Italy, the challenges you got going on with the UK. You mentioned the Shanghai Composite. A lot of people don't realize, but the Shanghai Composite has just violated an uptrend support line, so a technical term, since 1996. That's huge.
What?
Yes.
Wait a minute. So again, we don't want to get too deep in the technicals at this hour. Of course, in Europe, they're wide awake. But no, it's in Europe and Asia, it's not. This show does go out worldwide, but here's the thing. You just said we broke an uptrend that goes back 22 years?
Correct.
22-year uptrend broken in China.
On the Shanghai Composite.
Look out below?
Look out below. The longer the trend violation that occurs, the bigger the move you're ultimately going to get. And I look at a chart like that, and it could be down 20% from here, Brian.
How important, if at all, is the domestic Chinese equity market to our markets?
I think it's going to be very important for the global economy across the board. And not only did you have the problem with the Shanghai Composite, Brian, but if you go back and you look at a long-term chart of the DAX, you've got a perfect top in the making on the DAX, and you're just breaking below a very important technical support line. So not only do you got problems in Shanghai Composite, but also the DAX.
Do we just sell everything and put our money in a milk carton in the basement, or what do we do here?
Well, I think you got to be extremely selective. And we have been raising cash with our model portfolio and the work that we've done and recommending to clients to do that. So we want to be raising some cash. We want to be taking some of the high beta bets off because there are a lot of challenges around the world, and we need to really pay attention to this.